welcome back. Now, the final thing we're going to have a look at and consider in terms of the consolidated statement of financial position is dealing with how we calculate the cost of the investment in acquiring the subsidiary. Remember that we call the cost of the investment the fair value of consideration, and if you remember, we use that in calculating goodwill that arises on acquiring that investment. Now, within this F3 syllabus, there's two main ways how you would be tested in terms of calculating the cost of the investment. And those two ways that a parent company can pay to acquire a subsidiary would be as follows. The first way is for cash. We can purchase 80% of the subsidiary for X amount of cash. That's it, really. We've seen that a few times already in these last videos. But really the main focus of this video will be a share exchange. We purchase shares in the subsidiary and give them our own parent shares in return. And it's called a share exchange because we buy shares in the subsidiary and the parent will issue their own shares in return. A share exchange. Okay? So there's two different methods that we can pay for our subsidiary in this syllabus, cash or with our own shares. So let's take a look at first cash consideration. Now with cash consideration, all that we need to do is calculate the number of shares acquired in the subsidiary and multiply it by the amount of cash we're going to pay per share. So we could say to the subsidiary, we're going to buy 60,000 out of your 100,000 ordinary shares and we're going to pay $5 per share. Okay? 60,000 shares multiplied by $5 a share, that's going to give you the cost of the investment to buy 60,000 shares. So, let's have a look at how we could see this being tested and have a look at an example. P acquired 250,000 shares out of a total of 312,500 shares in issue in S on the 1st of April 2011, agreeing to pay $4 per share. Required. Calculate the percentage holding that P is acquired in S, and 2, calculate the cost of investment in S to be used in calculating goodwill. So 2 requirements then. Now the first requirement we haven't really seen. Usually we're told what the percentage holding we own in the subsidiary. In this case, we haven't been told the percentage holding. They want us to work it out for ourselves. Well, I think we could do that, couldn't we? So, to work out the percentage holding in S, and therefore to see if S is indeed a subsidiary of P, we take the number of shares that we acquired and divide it by the number of shares in issue. Well, if you look in the question, we acquired 250,000 shares out of a total of 312,500 shares. So, if we run that through our calculators, that's going to give us 0.8 or an 80% holding. Okay? That would mean then that S is indeed a subsidiary of the parent because the parent has control by way of more than 50% of the ordinary voting shares. Okay, so we've actually answered part 1. Calculate the percentage holding, 80%. The second requirement, calculate the cost of investment in S to be used in calculating goodwill. So, cost of investment, or fair value of the consideration. Well, we take the number of shares that we acquired, which we already said was 250,000 shares, and multiply it by the agreed consideration per share. Well, we said that we're going to agree to pay $4 per share acquired. Well, that must mean then that we must pay $1 million in order to acquire 80% of S. And we will take that $1 million and use it as our first figure in goodwill. Okay, so there we have it. We've calculated the cost of the investment and we've done the percentage holding in S. Not too taxing, really, dealing with the cash consideration. Okay, they either give you the figure for cash, which we've seen in past questions that we've done throughout this chapter, or they could ask you to calculate it yourself, number of shares multiplied by the agreed consideration per share. So, cash consideration shouldn't cause you too many problems. So what we're going to spend the rest of this chapter thinking about, and the rest of this video, is thinking about this idea of a share exchange. So, if the parent is giving shares to the subsidiary as a form of purchase consideration, we need to work out the number of shares given to the subsidiary using the following steps. So we could say to the subsidiary, yep, we're going to buy 250,000 of your shares, and in return, we're going to issue a proportion of our own shares in return. Okay? So it's a share-for-share exchange. The sub is giving me shares, and I'm going to give them some of my own shares in return, rather than giving them cash, or giving them cash as well as shares. Could be a combination of both. Focusing on the share exchange, though, we need to work out the number of shares that we have acquired in the subsidiary. We then need to work out how many parent shares would be issued, and then put a value to it. So, we do this in 3 steps. Step 1. Work out the number of shares acquired in the subsidiary. So if you don't know already, how many shares did you buy in the subsidiary? Step 2. Calculate how many parent shares will be issued in return for the shares acquired in the subsidiary. So do you remember with bonus and rights issues, it was a 1 for 4, a 3 for 2, that sort of thing? Well, it'll be a similar sort of basis on that. For every 5 shares I acquire in the subsidiary, I'll issue 3 of my own in return. So we'll need to work out the number of shares on that basis. Step 3. We then calculate the monetary value of the parent shares that we issue by multiplying the parent share price at acquisition. So if we know the number of shares we're going to issue to the subsidiary, we multiply that number of shares by the parent share price at acquisition. Okay? So the price the shares are currently traded at, the market value or fair value. If you follow those 3 steps, you can successfully find out the value of the share exchange, which would be used in calculating the cost of investment, which in turn would be used for calculating goodwill. So, let's have a look at an example then on a share exchange. On the 1st of March 2011, Placid acquired 80% of Salid's equity shares in a share exchange of 3 shares in Placid for every 2 shares in Salid. Salid has total issued share capital of $8,000 worth of $1 equity shares. The market price of Placid shares at the date of acquisition were $3 per share. Required, calculate the cost of investment in Salid to be used in calculating goodwill. Okay, so doing this share exchange then, we need to do this in 3 steps. So, example, share exchange. Well, step 1 is to work out the number of shares we acquired in Salid. Now, we can see then that we acquired 80% of their ordinary shares. Well, how many ordinary shares are in issue? Well, we've got $8,000 worth of issued $1 equity shares. That's what the Salad has an issue. We acquired 80% of them. Now be careful, $8,000, $1 ordinary shares. That must mean that there's 8,000 shares in issue. However, if it was $8,000 and it was 50 cents per share, you would have to take the $8,000 and divide it by 50 cents, or 0.5. And that would mean then that there's 16,000 shares in issue. So be careful, always make note of the par value if you're given the value of ordinary shares. Okay? So we've acquired 80% of 8,000 shares. But if they were 50 cent shares, we would have acquired 80% of 16,000 shares. And if you get that wrong, you get your entire answer wrong. Okay? Remember, this is a multiple choice exam. The answer you put into the computer, that's it. There's no space for workings. You don't get marked on your workings. So you've got to make sure you get this right. So, we acquired 80% of 8,000 shares. In other words, $8,000 worth of $1 shares. And again, if the par value was 50 cents, it would be 16,000 shares. Be careful. So, 80,000 at 80% means that we've acquired 6,400 shares acquired in Salad, the subsidiary. So we've acquired 6,400 of the ordinary shares in Salad. Now we've got to see how many shares the parent will issue, Placid, in return. So, step 2. Calculation of number of parent shares to be issued in return for 6,400 shares. Well, we know then we acquired 6,400 shares in the sub. And what was the terms for acquiring those shares? Well, the share exchange was 3 shares in the parent for every 2 shares in the sub. So, for every 2 shares in the sub, we're going to issue 3 new parent shares. Okay? So 6,400 for every 2 that we acquire, we're going to issue 3 of our own, which means the parent will issue 9,600 shares. And parent will issue. Now, of course, we've got to find a value to those shares, because obviously they're going to be worth something to the subsidiary, or else they wouldn't give up 80% of their share capital. So, the final step, step 3, is to calculate the value of parent shares issued. So calculate the value of the parent shares issued. So we know that we've issued 9,600 shares. And we value those shares that we've issued to the subsidiary at the current market price of each parent share at the date we acquire 80% of the sub. So, the market price for each parent share was $3 per share at acquisition, and as such, we're going to incorporate that here. So we're going to multiply that by $3 per share, and that's going to give us $28,800 as the value of the share exchange, and that would be the cost of investment to be used in calculating goodwill in the subsidiary. So that's the value of the share exchange, that's the cost of the investment, and then we'd add the fair value of NCI and take off the fair value of net assets to get goodwill. So, that's how you calculate a share exchange. Step 1, number of subsidiary shares. Step 2, number of parent shares. Step 3, number of parent shares multiplied by the market price of each parent share at the date of acquisition. And that's a share exchange. So, I want you to have a go at the final example on your notes, which incorporates cash and share exchanges together, because both together could be form part of the consideration as the cost of the investment. But now then, we've done with the statement of financial position and all the adjustments with it. Our next video will have a look at the group income statement or statement of comprehensive income. And then after that, we'll have a look at associate accounting as well. Thank you.